Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Travis Watts. He is a multifamily apartment investor. He's also a public speaker and the director of investor development at Ashcroft Capital. He dedicates his time to educating investors in commercial real estate and was awarded the Linda's Legacy Industry Impact Award in 2022. He's also been a guest on The Wealth Flow before, so I'm happy to have Travis back. So Travis, welcome again.
Hey, Keith. Thrilled to be here. Thanks for the invite.
Yeah. And I know we've probably gone through this before, but I always love to start with your background. What got you into investing in multifamily real estate?
Yeah, happy to dive into that. For me, it's really started back in high school and college, and that was well before I was prepared to pull the trigger on real estate or any kind of investing, but I was planting the seeds. I always had this general interest in, from books of, the Robert Kiyosaki books, the Rich Dad stuff and whatnot, that, passive income and cash flow, was always something that resonated with me and made a lot of sense. But like I said, I was reading and studying far before, I actually pulled the trigger. And I started in 2009 as I saw the opportunity in real estate that was presenting itself, and I thought, well, worst case scenario, I got to live somewhere, right? So I can either be a renter or an owner. And since owning is, roughly 40, 50% off almost in the market I was in, I decided to buy. And I said, I can get a roommate. They can help pay the bills with me. And it was in a college town. And so I started that way, and I think it was that check every month on the first, it was like $600, but my mortgage wasn't much more than that. And I thought, this is pretty cool. I'm almost living for free, right out of college and stuff. So that got the wheels turning. And, I went down a traditional route that a lot of people go down: single family homes, do it yourself, fix and flips, vacation rentals, buy and holds. I did that for about 6.5 years, just kind of as a DIYer, do it yourself, right? And then in 2015, I was introduced to a couple gentlemen that referred to themselves as full-time limited partners, which I had no idea what that meant, but they were essentially full-time investors, a lot in multifamily and syndications. They had sold their company years prior and just kind of put that money to work in these types of vehicles. So I got very inspired by that. It was like level 2 for me. So I stepped out of the game of do-it-yourself and single family, and I dove into a lot of multifamily and mobile home parks and self-storage and syndications, simply put. And I too became full-time limited partner. And so ever since, I've just been teaching others this game in commercial real estate, how it works and what some of the benefits can be if you choose to be a hands-off real estate investor instead of a do-it-yourselfer like I used to be. So joined forces with Joe Fairless at Ashcroft Capital in 2019, and that gave me just a bigger stage to play on, so to speak. And it's been an amazing journey. Just conferences, podcasts, workshops, meet and greets, property tours. It's just I really enjoy personally and professionally working, in the same sector. And so that's a little bit about me, my background, and what I'm up to.
Yeah, for sure. Couple things I want to maybe just obviously Joe is very well known in this industry, and so it's great that you had an opportunity to kind of team up with him. Curious if that was through you investing as a limited partner initially and getting to know him that way, or how did that come about? And then maybe a segue to that, or after explaining that, maybe just if you could, for the audience, talk a little bit about the distinction between the do-it-yourself piece and the limited partners and what you saw that you liked about it. You referred to it kind of as level 2, which I agree. I think, a lot of times we think we have to do it ourselves, and that's what, distinguishes you as an investor or whatever. But there's such a huge opportunity, and I know I would have made a whole lot more money if I would have just let somebody else run the projects, for me initially. So.
Yeah, it's a great point. I think, if you have a special skill set, an upper hand, an eagerness to, be hands-on, you want to do it for the learning aspects. I think there's a lot of great things that can be said for do it yourself or to be active in the space, to be a general partner or to be an operator. I'm in no way, shape, or form diminishing any of that. For me, single family, I was a complete novice. I'm not a handyman. I didn't come from any kind of construction background, didn't come from a real estate family. Like, I was a complete outsider, to your point, doing almost everything wrong and, getting beat up and taken advantage of from all these, third parties I was having to work with and contractors and getting scammed. And it was like, man, this is not for me. That's the bottom line that I came to the conclusion of. So back to your question, it was an interesting time. How did it come to be with Joe and stuff? I was working for one of the larger major brokerage firms here in the U.S. and, kind of doing the Wall Street stuff. And that came out of, it was a pure education play because I had come from the single family stuff. I was still doing that, by the way. And then I was like, well, I should learn the other side of this coin. So I'm not just a one-trick pony real estate guy. I want to understand investing holistically, So I was over there doing the Wall Street stuff, ended up leaving to get into commercial in these syndications. And I thought, if I'm going to be placing virtually all of my money into this asset class and into this type of structure, I should get a little better at understanding the ins and outs of this business and how it works and take a look firsthand at kind of the underwriting and the teams behind the scenes. So that's how it came to be. To your point, I wasn't a limited partner with Joe, with Ashcroft for several years leading up to me reaching out and saying, hey, how can I help you grow this company? I can speak, I can write, I can blog, I can go to conferences. Like, what is it that you need? And how can I fill that, for you? So it was really a good synergy and has continued to be, 6+ years in. And so, and this also came at a time where I thought, I wanted to start branching out to educate others on my own and teach this stuff. But what better way to do it than someone like a Joe Fairless that already has an existing platform with the best ever podcast and the best ever conference and the books and the, blah, blah, blah. I can just step into that world and become a voice there instead of me having to do it completely on my own. And it's something I really didn't want to do is my own kind of brand and business that way. I just wanted to scale with somebody else that already had momentum, basically. So that's how that came to be. I think your other question was the deciphering the differences between do-it-yourself and passive investing. Yeah, it's the way I look at it is passive income. That term gets passed around a lot, and is misused in many different ways. Some people will say, well, I own my own single-family home rentals, and that's passive income. I would argue it's never passive income when,
correct.
you're having to find the property, you're having to underwrite, you're having to show up to closing, you're having to make the decisions. Do you paint it? Do you replace the roof? Do you sell it? Do you refi it? I mean, this is active involvement. And what I found is I didn't realize that, sometimes when we have one property or somebody has one rental, it can be completely manageable with whatever else you got going on in life, right? But when you start getting to property 4, 5, 6, 7, like there just comes this pivotal moment. It's like, are you going to pursue being a full-time landlord? Is that what you are going to do with your time? Or are you career focused or focused on other things, and something's got to give is the point. And so for me, I was working some international stuff, and I was away from home for a month at a time, and it never failed. It seemed like when I would leave the United States, something would happen on my rentals. And either I couldn't be contacted, or the delay was problematic, or I was having to pull friends and family in to do these favors for me on these property, and it just got to be too much. I thought, this is not a scalable way to approach investing. If I'm already struggling on property 5, 6, 7, what's property number 40 and 50 look like when I'm older? Like, that's not a lifestyle I want to have. And so, the whole philosophy is, sometimes, in my opinion, you can't beat them, join them, I guess. It's like there were all these groups doing it the right way with skills I didn't have, with resources I didn't have, with connections to brokers and realtors and off-market transactions that I couldn't get. And I thought, well, why don't I just partner with them and invest in those deals alongside them? And it made a lot of sense. It still continues to. It's been an interesting 5 years.
Yeah, for sure.
We can definitely get in the weeds on that, and happen to be, very transparent as an LP. I'm somebody that does not try to time the market. I just invest every year, and you know what? You're going to hit some down cycles, and you're going to hit some flat times, and you're going to hit some great times. But I don't ever have to worry that I accidentally set the market out for a decade, right? And didn't get to participate in it. So.
Yeah, that might be an avenue that we can go down for a little bit here, right? Because you guys have such a vast experience in multifamily in particular. And I'm not sure what else you guys invest in. I know for sure the multifamily, but we can stick with multifamily. It's obviously gone through a huge transition, since interest rates spiked up, the biggest gain in interest rates ever, right? In such a short period of time. And and then we get through this period where they're starting to dial down, and truth be told, interest rates aren't that bad right now. They're really in an okay spot. If you look historically, it's really not that bad, but it does affect cap rates. It does affect expectations from sellers, and expectations from buyers. And so, what are you seeing out there? And I guess just take us through some of what you've learned through the last several years.
Yeah, I think some hard lessons learned, right? Let's just dive into that. So from 2015, which is when I started, LPing, if you will, through 2019 and early 2020 before the pandemic, things were what I would consider, very normal. I mean, we were normal in the sense that we were in a growing, expanding bull run market, which started around 2012 or so in real estate in general, right? Depending on the market and asset class. And so all of a sudden, this whole syndication stuff got real popular with the crowdfunding and all the changes that were happening, politically and everything. And so a lot of these conferences and books and coaching programs, everything was popping up about syndications, and some of the returns that we were getting were exceptional. I mean, 20, 25% annualized returns, double your money in 4 or 5 years. It was incredible. So we had this kind of blow off top in 21 and early 22. And so, the pandemic was scary, shut everything down. Everything softened almost overnight, instantly. We fell out of contract on a bunch of deals. It was just a weird time for everybody, right? No one really knew what was happening or what the future held. But as the economy started to reopen, businesses started to come back, stimulus money started to get pumped out. I think people started realizing it's going to be okay. We're going to get through this somehow. And it looks like that's about to happen. So, everything was up, if you remember, in 21. I mean, crypto was up, stock market was up, real estate was up. We were getting rent bumps of 15, 18%. It was insanity when the norm was like 3 or 4% a year, for a rent increase. So we were going through an entire business plan in 1 year, and effectively we were done and selling early. And then the Fed steps in to start cooling inflation. They start lifting rates, to your point, at the most aggressive pace in U.S. history. And we go from effectively a 0% rate to upwards of 5%, And in commercial real estate, first of all, most people do use debt. Okay, so it's a little bit different than, say, single-family homes where you have a lot of cash buyers and stuff like that. You do have some of that, but not as much, because we're talking $100 million purchase prices, right? So you got to think, what happens to a mortgage payment when you go from, say, 3% to 7% in a matter of a year or two? I mean, that's the biggest common denominator, right? To like eat up your cash flow and stuff like that. Number two, it's very common in commercial to have floating rate debt and to have bridge loans and short-term debt as compared to, again, single family, which mostly is 30-year and 15-year fixed rate mortgages these days. I think we all learned that lesson 6, 7, 8, 9. I mean, the great financial crisis, right? And then, what really caught a lot of people off guard were in commercial was, okay, we recognize there's risk in floating rate, okay, but two things. December of 21, the Fed says, yeah, we're going to increase rates more than likely, but maybe to like the 2% level Fed funds rate, somewhere in that range, Well, they went to 5, right? So you couldn't have taken any of that to heart in hindsight, right? These forecasts were completely wrong, which hurt bad.
Right.
And then two, a lot of us thought we can buy these rate caps and it'll protect us against rising rates, right? It's like an insurance policy. If you got a 3% loan, you get a 4% cap. And it's like, even if rates go to infinity, you're capped at 4%. The problem is those are short-term vehicles, 1 year, 2 year, 3 year types of caps. So what happens when that cap expires? Well, you have to get another one. And what happens when that $100,000 rate cap goes to 1.1 million 18 months later? You got to pay for it, right? How are you going to pay for it? Stop distributions, do a capital call, or you can't, take on affiliate loans. There's ways to do it. But I think that was the wild card that really hurt bad, because values came down, to your point, 25, 30%, depends on the asset in the market and the vintage and all that. So it's like this perfect storm where, prices are coming down, rates are skyrocketing up, inflation's hitting, an all-time high on wages and materials and renovation cost, right? And you just can't get the rent bumps because you got all this new product coming onto the market, and that was more of a recent story. And so it's been a very, very, very challenging few years. And a couple things I've learned as an LP, because I invest with a lot of groups in the industry, is every single deal that I was invested in pre-pandemic and pre-interest rate craziness, right, that had long-term fixed rate debt, okay, and we were doing like a value add plan, none of those deals got affected. Because we weren't going to sell anyway, and we're still not looking to sell. So there was no, the fact that values came down doesn't really matter because we're in it for the cash flow. And two, we didn't have to do a capital call or a pause distribution or anything because the fundamentals have held up, relatively strong for multifamily. So occupancy and collections is what I'm talking about, And so we just keep cash flowing, all the way through. Now, some of these 21, 22 deals that I did with floating rate and caps have been problematic. I think a lot of us hoped that survive to 25 was a thing and that January 1st rolls around and like, oh, we're all good and off to the races. That just hasn't materialized, mostly because of all the new supply hitting the market still and all of the uncertainty still in the economy and whatnot. But yeah, boy, it's been a roller coaster of kind of that normalcy, that crazy boom, that crazy bust, and now kind of a recovery phase starting and beginning. So ultimately, a great time to get in, buy the dip, work with, some great operators and just ride the next wave. But that sentiment is not widely heard, which is a reason I was so excited to come onto your show, is that there's far more negativity. There's a lot of recency bias, which is like looking at the recent, problems and just saying these are never going away. This is just here to stay. But there always is the recovery, right? And we're already starting to see, record high demand, really high absorption. Rents are starting to trickle up finally. Transaction volumes coming back. Big institutions are stepping in and putting billions into this sector. So smart money is active. It's happening,
It
So,
is.
my best advice for your listeners is just, whether you've been in this industry already or you haven't yet, really consider, buying the dip at a 25, 30% valuation dip, because when you look around, nothing else is really offering those kinds of discounts, right? Single family's not, crypto's
Correct.
not, stock market's not. We're hitting all-time highs across the board and a lot of discounts here in commercials. So great time to be shopping.
Yeah, it is. And I think you still see as well, like you mentioned, single family, I know just at least locally here, prices have continued to go up.
Yeah.
There was a little bit of a flat and a little bit of them turning down, but like they have continued now to go back up year over year. And, inventory is starting to sell a little bit more, over prior, up 4%. And so when you start to see that and you see that the prices of homes is up here, you're still going to have the need for the renter and a need for the renters to live somewhere. And that's not going anywhere until the affordability piece gets solved. And I don't think it will. I mean, it's, we're always going to be outpaced. You're not going to solve the problem of, entry level housing all of a sudden becoming extremely affordable for first time buyers. We're going to always be a little bit behind that curve, I think. So there's always going to be that demand. What about, mentioning some of the things, and you didn't mention necessarily, the other thing that we saw a little bit of, which is, and it didn't happen across the board. It was in certain areas, but particularly in some areas, insurance rates went way up during the same time frame. Like, so talk about like another, just throw another thing on there to kind of destroy some of the returns. Like these renewals were coming in significantly higher than prior years as well.
Absolutely. So a lot of that began, so again, if we kind of back up to the pandemic, right? Everything shuts down, everything starts to reopen. Well, just because it reopened doesn't mean we were, obviously back to normal day one. There was a lot of supply chain disruption. Okay. There was a lot of, you can't get windows, you can't get appliances. My wife and I were renovating, coincidentally, our owner-occupied home in 21, and it was a nightmare. It was like, we couldn't get a matching set of appliances. You could get the fridge in Florida, you could get the microwave in Denver, and then everyone sold out of the oven, everywhere worldwide, and it was just ridiculous. Plus, you're paying 30% extra just to get them in the first place. So, our turn cost, just to give some perspective to this at Ashcroft on a apartment unit, pre-pandemic was about $7,500 per unit, and today's about $16,000 per unit. So it kind of gives you an indication of how much things went up. So we had to get real creative in buying bulk supply overseas. We got warehouses built out in Dallas for storage, and whatnot. So things like cabinet pulls and shower rods and ceiling fans and light fixtures. We started buying in bulk, custom made for us, about roughly a 30% discount, to what we were paying locally. And mostly it was to circumvent the supply chain disruption, so that we knew in our warehouses, we've got 2,000 door handles, so if Home Depot's only got 50, like, we're not, sitting around for 6 months waiting. We can just go ahead and carry through. But yes, insurance and property taxes, and most notably in our portfolio, that would be Texas and Florida, that we saw the biggest increases in premiums. It's like, what hasn't been unprecedented in the last 5 years? I hate that word, but it's like everything's unprecedented. Like, this has never happened before. 30% year over year insurance premiums, going up like that. And so, yes, to your point, it's like you're not getting the double-digit rent growth to help offset these costs. Right. So you're buying at a peak price. You're really not going to get what you hope to get as far as rent bumps in the future, and then your material cost and everything else went way up. So it's just been a very flat, stagnant, and declining era for almost 3 years. But this is what I like to tell people is when you go back and you look at market cycles of real estate and go back to any period in U.S. history, the down cycles tend to not last more than like 2 to 4 years. That's kind of like, a sweet spot. It's like we don't go down and then just sit here for 10 years, which is what everyone in the media likes to, try to paint the picture of. So we're there. We're in like year 3, basically. Things started coming down in late 22, 23, 24. Here we are in 20. This is the tail end of it. You know what I mean?
Right.
That's my opinion, of course, but it's also a lot of data from CoStar and CBRE and Marcus and Millichap, you name it. You go out there and look at the data. Things are turning to the recovery phase in multifamily. So again, anyone listening now, be fortunate that, the timing is probably pretty near perfect right now, in my opinion, in general, to get in. So
yeah, I think so too. I believe that, and I saw it in kind of coming out of 2007, 2008. I was in real estate full time during that time, more as on the brokerage side.
Okay.
But and it seemed like, it lasted a lot longer during that time than I expected, but it eventually did turn, and gosh, I wish I would have started buying stuff sooner during that time frame as well, and so, I think it's a good time to get in. How about when you're underwriting or when your team is underwriting? Tell me if there's anything, whether it be, how much debt you're taking on these various things. What has changed since over the last 4 years? Are there assumptions that you're doing differently? Are there capital stacks are different? Like what are you coming into these with?
Yeah, a few things have changed notably with lenders, as really the last year and a half's been nonstop, calls with lenders and, trying to get loan modifications and doing all this kind of stuff. One is, a lower risk appetite in general from lenders, right? So it was not uncommon in 21 and early 22 for some of these groups to be, 80% leverage, even, 75%, which sounded good on paper until values went down by that much. And so now it's like, all right, 60 to 65% leverage, right? Which means you need more money in the deal and more equity and more capital raising, which, by the way, has never been harder, statistically speaking. So you got this double-edged sword where it's like, yeah, it's a great time to buy and things are on sale. But if your lender says 60% leverage, and you're not going to use, pref equity or anything else, are you going to be able to go out and raise, $20 million for a deal or more, depending on the deal size that you're doing? DSCRs, a little bit higher. It's just become, the lenders took a step back because of the risk profile, right? And it's like, basically, how do we take less risk at this point?
Right.
lower deal volume up until somewhat recently. So it's been really hard. Deals have been trading hands a lot off market and a lot to these big institutions and not to syndicators or mom and pops and stuff like that. We're just, another thing to highlight, we took the stance because of our investor feedback and appetite to just start doing fixed rate debt. And to your point, it's really the debt's not really that bad, especially if you go agency like we tend to do, Fannie and Freddie, fixed rate, 5 to 7 year kind of stuff. You can get, around 5%, roughly, for your debt. And if you cash flow at 5% on today's purchase prices, then, you don't have to be so glued to CNBC. You know what I mean?
Mm-hmm.
You can give it the 5-year runway. And hey, if rates do come down in a meaningful way, refinance or sell, something like that, maybe even early, based on your business plan. But if rates stay exactly where they're at, okay, we can still be profitable. Again, back to the perspective of deals I was in 2015 to 2019, rates were kind of in the same little plateau the whole time, and we were generating pretty sizable, returns during that period. So what I like to highlight now is that there's a real case out there for rates coming down in the next 5 years. I mean, they're already coming down, right? The Fed's cut twice in 25, once in 24. Expectations are to keep cutting into 26, 27. So in theory, right, we don't base our underwriting off of this, but in a couple of years, rates should be in a better spot, to make things more affordable and to help boost potentially valuations. But don't count on it. I don't have a crystal ball, neither does Joe or Ashcroft, but underwrite to cash flow, basically, and then structure your deals to be able to continuously cash flow through these cycles. I think that was a very, very difficult lesson and pill to swallow, so to speak. For someone like myself, full-time cash flow investor, and then seeing 30% of your deals get paused on distributions, that can be painful. So structure is more important than ever.
Yeah, for sure. How about assumptions on rent growth? Any changes on that moving forward, or what are you kind of anticipating? And it could be, obviously, it's going to change market to market. Obviously, you're going to look at each individual deal, but in general, what are you seeing?
Yeah, it's funny how markets work, right? Like for example, you had Austin and Phoenix kind of leading the nation and this rent growth and this huge boom and valuations. And then as the tides turn, they're the fastest falling markets in the nation, right? And they're going like negative underwater. And it was the Sun Belt, was the shining star and still is in many ways, but temporarily, the Midwest has been picking up, and you're seeing a lot more positive rent growth in a lot of Midwest places. Not all of them. There's exceptions, I think Denver's kind of in a flat softening right now. But yeah, New York's back in the news as like one of the number one markets. Is like, what?
Yeah.
If you look back, there's another interesting data point. If you look back at like the last 50 plus years, as far as inflation and rent growth goes in real estate, they tend to keep in line. And in fact, real estate rents on average go up more than government stated inflation throughout history. But obviously there's exceptions, right? There's periods of time where that's not true, which is what we just went through in the last couple of years, where inflation went up like 8% and then rent growth came down to like -2, right? So there's a divergence right there. We're just staying with kind of the 0 to 3% kind of stuff. Again, to your point, depends on the deal, depends on the market. Give you a prime example. We have this Class A property out in Orlando. It's where I live. And we bought it from a group that was in the process of leasing it up with concessions and discounted rents so that they could get it stabilized and occupied. Well, when it changed hands to us, the rents were roughly $100 below market on day one because they weren't pushing to the market level, right? Their goal was different than our goal. So we've been doing all these lease renewals at 100% bumps in that particular property, which is a higher rent bump than we're seeing on any of our other Florida properties right now. Those are going at like 0 to like 1% rent bumps. And over here, we're getting, a pretty sizable, 5-6% rent bump or something like that. So it's very dependent on the deal and the circumstance in the market. But it's one reason too, I love value add properties, because you're coming in and the rents should be below market because you need to fix some stuff. And once you fix it, then people are willing to pay a little bit more for it. And therefore you're forcing a rent bump and not just dependent on what the market does in general.
Yeah, for sure. And I'm sure this changes from deal to deal as well. But in general, what does Ashcroft focus on? You mentioned a Class A in the last example, but what do they focus on? What's sort of the property that you're focused in on as part of your buy box?
Yeah, another thing that's changed, to answer your question there, since the pandemic has been the vintage, because we're a firm that sells and buys, but mostly sells our deals to institutional partnerships. So think about, whatever, just naming some names, Goldman Sachs or BlackRock or Blackstone, right? So the institutional appetite has shifted more towards newer vintage, which is why now we're exploring these Class A deals and these B+, which we had been doing B+ all along. But when we started as a company, we were more of like a C to a C+ kind of asset. And now we're like an A to a B+ because of institutional appetite. That's really it. It's been more challenging to take some of our older deals that we still have in the portfolio, let's say a 1975 vintage, and we're seeing that the cap rate spread is pretty drastic compared to Class A. So meaning that the values went down more on the older stuff, and rightfully so. The way I look at that, the cap rates never should have gotten so tight between Class A, Class B, Class C. They got real tight in 21 and 22, and it just didn't really make sense in hindsight looking back. It's like, I've owned a lot of, single family homes that are like, I had a 1932 house in Denver. And, beautiful architecture and all that. But let me tell you, that thing was a problem. That thing had a boiler system and radiators in it and an evaporative cooler that broke so many times, and just the pipes and the electrical and those homes should sell at a huge discount. They really should, because they're a nightmare to handle them. But it's not always how it works, right? Markets are funny like that. And that home was just going up by leaps and bounds in price. But point is, almost every C-class deal I've ever invested in has had more problems than the A and the B, just across the board, from negative reviews to floods to boiler systems to roofs to leaks to plumbing. They're just old. And so old requires more maintenance, And so anyway, we're kind of more going the turnkey route a little bit. It's still, we still consider it value add because there's operational changes we can make with value add, and like that one's a real unique circumstance with bumping the rents and not having to turn the units, So there's still a value add component. We're not just a group that buys and then says, okay, let's sit here for 10 years and see what happens. We're always trying to improve these properties.
Okay. How about from an exit standpoint? What are you looking at? You mentioned kind of, as we talked about, some of the differences kind of leading up to the interest rate hike. How you could almost implement your entire business plan in such a short period of time. Yeah. And you probably didn't tell the investors that you were going to be able to get out that quickly. Sure. Yeah. But have you extended the time frame at all? Are you looking at like a 5-year hold, a 7-year hold? What is it now?
We've always been a group to underwrite to 5 years on a single asset and 7 years on a fund with multiple assets to give us that extra runway room, and for the acquisition year of acquiring, the properties into the fund. So how has it changed? Well, before the Fed came in to hike rates in 22, we were a group that was known to say 5-year hold, and then in 3 years, surprise, we're selling, and we're
Yeah.
giving you, what you hope for and then some. That was basically our story and a lot of people's story. And that was a great moment in time. It was like the golden years.
Yeah.
Ever since 22, anything that we were holding prior or during, right, has basically been extended. As we're coming up now on like a 5-year point to some of these deals, looking at 26, we likely will not be selling in 26 just because we think values will still be compressed. We still think there's room to go. And if you're not forced to sell for any reason, then why do it? If you could get more the next year. So we're targeting 2027, 28, 29, just depends on the deal, and how long we've had it. But that's something for LPs to think about. These are illiquid investments. And just because somebody says 5 years, it's not an exact science. It might be 3, it might be 4, it might be 6, it might be 10. So you just have to be flexible if you're going to take this approach as an LP investor. But no, for sure, we want to be as opportunistic as possible with the market. And we don't just want to say, okay, we're at the bottom of a cycle, but hey, we told you 5 years, right? And so we're going to wipe you out and do a sale across the board. We don't want to do that, obviously. So we're holding on longer.
Yeah, makes good sense. How about let's maybe talk a little bit about your strategy as far as selling to institutions. You mentioned funds, and I would assume that's the way that's typically going to happen because it's going to be multiple apartment complexes built into one. What is kind of the sweet spot for institutions right now? How big of a portfolio? I know it can, they obviously can have the ability to take down really large, but kind of what's y'all's sweet spot when you're designing a fund and saying, hey, look, we'd like to see this much, as far as assets under management within the fund?
Yeah, it depends on the group. First of all, we've definitely sold single assets just by themselves. That does happen. But to your point, it's typically that we're going to have a handful of deals that we're potentially looking to sell. Let's call it 8 deals. We'll show an institution those 8 deals, and they may be all over the place. A deal we bought in 2019, a deal we bought in 22, a deal we bought in, whatever. They're just, one's in a fund of ours, one's a single asset, and they kind of cherry pick, for the most part. We want this one, none of the others. But that's just that group's preference, and then another group comes in and they might want, the other ones there. But in general, the more the turnkey accessible, what am I trying to say? The more the property is turnkey and easy for them, the more likely they're going to have interest in it. So if we can go in and say, look, it's a 300 unit, we've turned every single unit, we've renovated every single one, we've got the rent bumps in place, we're 95% occupied, 95% collections, whatever, that's going to be very appealing. As compared to, here's a 1975 300 unit, we've only turned 100 units,
Right.
we're struggling getting these rent bumps, blah, blah, blah. Like, it's just that institutions are just a whole different animal. They usually have deep pockets, big money, but not necessarily the infrastructure to come in and have the desire to go turn units and, replace windows and HVAC. They don't want to deal with all the problems. And that's kind of where we, where we're situated in the industry, kind of that yin and yang. We come in and buy something distressed and outdated that needs a lot of work and improvement. We make it newer, nicer, and safer, and then we sell it as a turnkey property. And a lot of times we do what's called a recapitalization versus just a straight-on sale. And that would entail we continue to manage the property, but we'll take an institutional player in the LP position, and that buys out our LP investors. And so we actually continue, operating these properties in many cases with an institutional partner as our investor. But it's treated much like a sale for the LP. It's like, hey, we were in the deal 5 years, here's your money back plus your profit. We're done. Do you want a 1031 or not? That kind of stuff. So it on paper doesn't look a whole lot different. It's just a different strategy.
Yeah, makes sense. And so do you still stay in the investment as some kind of the general partner, and
Right.
you're just using them for the capital?
Yeah, exactly. And again, it's, case by case basis, not to imply
Right.
that's always the case, but we have done a lot of that. In fact, we're going through a couple right now like that, recapitalizations.
Yeah, makes sense. Well, this has been great, Travis. Is there anything that we haven't touched on that you'd want to convey to the audience that we just didn't get to yet?
A couple things to think about in 2025 and as we move into 26 is the rising demand. I mean, it hasn't been higher since, the reopening of the economy in 21 as far as apartments go. Um, Lower new supply, we haven't really talked about, and I'll just be brief on it, but developers have largely pulled out. And to your point about we don't have enough affordable housing, well, it doesn't help when no one's building. So
Right.
here we are just going further and further behind. You can look at new permits, new starts for multifamily. They're falling off a cliff. So we
Yeah.
fast forward 2 years later, it's a supply and demand game. And we're going to have a lot of demand and very little supply. And it takes years to build. So it's not like we can just, fix that all of a sudden in 27 from scratch. It's going to be like 2029 by the time, things start to come and hit the market. High absorption, stabilized occupancy, good collections, stuff like that. Rent growth starting to happen again, growing transaction volume, smart money coming in. I know I already mentioned a few of those, but these are all, we went from 2 years ago, almost every key metric looked bearish for multifamily. And now, arguably, almost every metric looks bullish. So just think about that in terms of your timing. And I know it's always scary. I struggle with it too as an investor. When things fall, like if the stock market tomorrow just fell 50%, like it would make a lot of people nervous. And even though that'd be a great time potentially to get in the market and ride the wave back,
Yeah.
I bet very few people would actually do it, And so we got to remind ourselves of kind of the Warren Buffett quotes and all of that, be fearful when others are greedy and greedy when others are fearful, stuff like that, buy the dip, whatever. So dollar cost average is kind of my saying. My
Yeah, for
philosophy.
sure. No, all good points for sure. It is truly a great time for people to jump back in. How can people find out more about you, more about Ashcroft, and if they would like to invest? How does one go about doing that?
Yeah, I set up a website, speakwithtravis.com. It's got my calendar on there. I give away 15-minute intervals of my time. Willing to talk about anything and everything that we covered or didn't cover here, Ashcroft or not, cash flow investing in general outside of real estate. I do a lot of this stuff. So always happy to be a resource for people. And that's the best way to reach me.
Perfect. How about any advice you would give somebody? And some of it may have just come out a little bit before what we just asked, but any advice you'd give somebody who's maybe just starting out in their investment journey?
I would say that, so if, first of all, pay attention to cash flow and passive income. That does not have to mean multifamily apartment syndications. Okay. There are vehicles out there that you can literally start. I've done my nephews and my 3-year-old with a brokerage account where some of these REITs or stocks will pay 5, 6, 7, 8% a year, and you can buy them for as little as $10 a share. So like literally a free brokerage account at a big brokerage house and $10, and you're in business and you're cash flowing. You know what I mean? So don't get too intimidated by $100,000 minimums. I have to be an accredited investor to do this, blah, blah, blah. Just get started with cash flow in some capacity and just start to grow it. And, again, I started with single family until I built up enough, wealth to get into the larger stuff, and so that's how that can evolve over time. But don't wait, don't just say, yeah, cash flow, maybe when I retire, cash flow. Start to learn the game now. So that you're an expert by the time you get there and you know exactly what you're doing.
Yeah, I think that's great advice. Last question is just a book recommendation. Doesn't have to be real estate related, certainly can be. Just something you've read that's been impactful.
It's shameless, man. It's so shameless. I'm going to mention my book. It's called Passive Investor Tips. It's on Amazon. But here's why I'm mentioning it. It's not necessarily a real estate book. It goes over a lot of different asset types that I've done over the years, kind of the pros and cons, the risk and reward ratios. They're real short chapters. I mean, the whole book's like 150 pages. It's nothing.
Yeah.
And each chapter is like 3 or 4 pages. So you can, it's a good... travel book, nighttime book, weekend book, whatever. And the point and purpose of that book was to expand the way people think about cash flow investing. Again, not to get so intimidated and feel like it's not something they can do, but just the opposite, to think, gosh, if I just try a little bit and I have $10, I can do something and I can start this journey. So, Passive Investor Tips.
Yeah, that's great. Well, Travis, this has been great. It's been wonderful to have you on The Wealth Flow again, and I think we'll call it a show.
Thanks, Keith. Thanks, everybody.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter, and as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.